Hello, this is Gary Sherman of Whaddadunce.com. Today we're going to start our series on how the financial markets price risk. And we're going to answer the question, where do discount rates come from? So let's start our discussion with a hypothetical investment. Imagine that we have this investment. A retired investor is considering betting his entire net worth of $500,000 on a coin flip. Now, if we go to E1, these are our investment payoff matrix. Now, there are two outcomes. There's heads and tails. If the investor flips a head, he receives $1 million, and the probability of that is zero point 0.5. If the investor flips a tail, he receives nothing, and the probability of that is also zero point 0.5. Now, if we go down to E2, that's the expected payoff. What we do is we probability weight all of the outcomes and add them up. So, in other words, if we conducted this bet, let's say 1,000 times or 1,000,000 times, half of the times he would get a head, half of the times he would get a tail. So the question is on average, what would this investment pay off? So what we do is we take the outcome of rolling a head or flipping a head of $1 million, and we times that by a probability, which is zero point 0.5. Then we add the outcome of the investor receives nothing if he gets a tail, and we probability weighted that by zero point 0.5. We add that up and we have the expected payoff of $500,000, which also equals the initial investment. So if we go to E3, this is the investor's expected wealth. So the investor starts out with $500,000. The cost of the investment is entire net worth, so it's $500,000, which is a negative. But we also have to add in the expected payoff, which is the average payoff, which is $500,000. So at the end of the day, this investor's expected wealth is going to be $500,000. So it's going to be unchanged. So the question is would this investor make this investment? Now, if he was risk neutral, he would make this investment, and here's why. A risk neutral investor basically says is if the expected payoff is equal to the investment amount, I'm good. So even though half of the time I'm going to receive nothing and half of the time I'm going to receive $1 million, those two cancel each other out such that my wealth is unchanged, so I'm good. These investors really don't exist. Whenever we talk about risk neutral probabilities, usually what we're doing is we're pricing options, derivatives, which we won't cover here. But in actuality, risk neutral investors do not exist. The investors are risk averse, which means they weight the downside more than the upside. So in this case, the downside is being destitute, and the upside is in having some extra cash. So what the investor would do if he's risk averse, which all investors are, he would weight the downside of being destitute more than the upside of having some extra cash. So therefore, based on these parameters, the risk averse investor would basically say no, he would not make that investment. So how would we induce this investor to make the investment? There's two ways. Number one, we could keep the payoffs the same, and we could say, well, rather than investing 500,000 on this coin flip, only invest 300,000. So the payoffs are the same, but the cost of the investment is only 300,000. Another way to compensate the investor would be to change the probabilities by saying, yes, the investment cost 500,000, but we're going to weight the coin such that the probability of rolling ahead or flipping ahead is much higher than 0.5, and the probability of flipping a tail is much less than 0.5. So those are two ways that you can actually compensate this investor, this risk-averse investor, for taking this risk. Now, in this graph, we describe the relationship between risk and return. And this would be the relationship for the risk-averse investor. So note that as risk increases, that's a horizontal axis. Return also demanded by the market also increases, which is a vertical axis. So we start out at the risk-free rate, which we typically define to be the U.S. Treasury. So the U.S. Treasury rate for the 10-year in July 2026 was around 4.7%. So that's where we start. So if this investor, this risk-averse investor, wanted to take zero risk, then he would invest in the U.S. Treasury. But as his risk tolerance increases, so does the required rate of return. So as we go from the U.S. Treasury rate to the right, as far as risk goes, the required rate of return also increases. So in summary, the greater the risk, the greater the return demanded by the market. But we have a problem. On the horizontal axis is risk. So therefore, we need a number. We can't put in on the graph the chance of losing my shirt, the chance of being destitute, the chance of running out of money in retirement. We actually have to put a number on that horizontal axis. And so we will go to great lengths from here on to describe exactly, how risk is quantified. Part one of our series will be milkshakes and the financial markets. In this part, we will introduce utility models and their role in finance. Part two will be pricing investments via utility models. In this part, we will apply utility models to price risky investments. And then part three will be the capital asset pricing model, or the CAPM. And in this part, we will introduce the CAPM and use it to calculate risk-adjusted discount rates. So come join our community at Whaddadunce.com. It should be fun.